Welcome to another episode here on the channel. Today we're going to talk about what happens if you buy Chinese stocks and if you live in America or in Europe. What you have to think about and the potential risks that you are taking. We have lately seen that has been more talk about again about investments in China and potentially Chinese stocks being on the rise. Obviously, we know some of the biggest investors from USA like Charlie Munger and Ray Dalio always has talked positive about Chinese stocks and China being like very important for the future. But still, for me, I've always had my doubts about investing in China, and that is based on specific rules and ownership issues if you are participating in the investments. So this is if you buy the stocks through like the New York Stock Exchange or the Nasdaq. It's not if you buy through like the Hong Kong Stock Exchange. So depending on where you buy the stocks, there are different rules that are being used, so to speak. And as an investor, you need to be very careful. So this is what I'm going to talk about today. So you just need to relax and enjoy the ride. I would say that this is actually why I don't own any Chinese stock anymore. Back in the days, I owned, for example, JD.com, a very interesting Chinese stock that are a bit similar to Amazon in the USA, and I thought they were like Amazon, but the growth was better. They looked like a very interesting stock, but these specific ownership rules made me question if I really could be an owner long term and just feel relaxed about the situation. So this is quite serious. So let's get down to business here, and I'm gonna tell you about the specific rules here. So what we call it is YIE, a variable interest entity structure. So this is what that type of structure that is in place for you to own Chinese companies as a foreign investor. And actually, you just get exposure to the Chinese firms, for example, the Nasdaq. Through a variable interest entity, you can bypass Chinese laws that restrict foreign ownerships in certain industries. So basically, in China, they don't want foreign investors to own companies, because if they own the companies per se, they will have an opportunity to impact the Chinese community as a whole, and that is not allowed. So this is like a workaround sort of solution. And how does it works then? Well, in an VIE structure, the US listed company, the middleman, so to speak, typically does not own the Chinese company directly. So the middleman is like when you buy a Chinese stock on the Nasdaq, for example, the ownership go through the middleman. So you don't own like the stock directly. So it's a sort of a contractual agreement, like service contract, with a set of entities that control the Chinese businesses. And this then gives the US companies economic rights, profits and losses from the Chinese companies. So basically this means if you own the stock and the stock have like a lot of profits, you will be a part of that potential gain in share price, etc. So that is like how it's supposed to work. But basically, the stock market also is not just profits and losses and revenue. It's also about beliefs, etc. It's sort of, you can compare it like being at a casino, for example. In terms of, it's just not the fundamentals that drive stock prices, it's also the beliefs and what people feel about the stock. So Chinese stocks has for some time being, in terms of stock price compared to revenue being cheaper than American stocks. And obviously the ownership structure is part of it. So as a new investor, it's quite easy to look at the Chinese companies and say, it's a bet, this or these companies are a bit better priced. They have a lot more revenue and profits in comparison with the share price, so I should invest here. And then you go in and you don't understand why the share price are going down despite the performance of the company being very good. So what you need to know about the VIE structure then is that the US investors, for example, it can be like Canadian investors or German investors, they own shares in the US listed entity. So it's not directly in the Chinese operating company, which then creates a disconnect between the ownership and the control of the company. So, well, as I said before, you can have the profits, but you will not directly legal control over the underlying Chinese entity. And this means some risks. You have the legal risk here, because the Chinese government, they does not normally recognize this type of structure as something that they are very pleased about, even though they haven't done much about it. But lately, like 2021, they started to look at this a bit more harsh, which can put off investors. That makes it a bit more risky, because if in the end of the day, if they decide to like just shut this loophole down and you own shares through this type of structure, what would happen? That was my feeling when I owned Chinese stocks. I was like, can it like overnight just disappear if they change the rules? I don't know. Then you might wonder, why doesn't they change the rules? Because obviously they don't want direct ownership, and that's probably because in the end of the day, this is still capital going into China, and they want capital to go into these type of markets. So that's why it's like a balanced act for the Chinese government. It's also some control risk, since the US investors doesn't directly own the Chinese companies. They do have like limited control, and obviously the regulatory risk here is legal uncertainties in China. And like the SEC have raised concerns about the transparency of the investors. And we have like transparency issues based on accounting principles that might not be the same in China as in the USA, for example. So we have had some problems there. So if we go down here also, if we see like, we also have like, if you buy this type of stocks, you have something called the ADR, and the ADR represent the ownership structure of ADR may still rely on like what I say, the VIE structure. So it's quite similar. You don't own shares in the Chinese company directly. So when you buy stocks this way, it is often called ADR, for example. And 3, the ownership rules and restrictions for US investors. So it's an indirect ownership. So we already talked about that. The middleman holds the legal rights to the Chinese companies and probably works with the Chinese government. We have the US regulatory oversight, which require transparency for companies listed on the US AX exchanges, and that has caused some problems for some Chinese companies. And I'm just gonna see if I can bring back there. Thank you. And also this Chinese regulatory crackdown, they enacted and stricter regulations on data security and online services, which directly affected Chinese tech companies using VIE structures. So this and the last one here, potential for delisting. This was like the reason I was afraid to invest. Due to ongoing regulatory concerns, some Chinese companies listed in the US face the possibility of delisting under US laws, like the HFCAA. This act requires foreign companies to comply with US audit standards or face the possibility of being removed from US exchanges. So that is also a risk. And obviously, if you invest in a company and suddenly there are regulatory problems, the stock price might fall fast, and you really need to really have full control to being able to sustain the psychologically the pressure that the stock market put on you. And this is what made me question this type of ownership for myself. Still, if you really understand the valuation in investing this way, there are still possibilities to earn money, obviously. But I have had really hard problems just to like if you invest like me in terms of economic metrics, just to see like the price per earnings, price per sales for the Chinese companies doesn't really match the share price. So it's very hard to analyze it through that perspective and make a great decision. So, and I don't want to take like random chances and gamble in the stock market. So before you invest in Chinese companies, you better think about this, and maybe you need access through the Chinese markets in more direct ownership through like Hong Kong listing or even from China. So they did some summaries here. It's a great way to bypass the Chinese ownership law restrictions, but carries some significant legal and regulatory risks. And obviously, as in this channel, I want you to understand how the market works, and I want to increase your knowledge in all types of situation that has to do with investing and stock markets, etc. And investing in Chinese companies is a quite important thing. It's quite popular, and if you don't know about these things, you might just buy a stock like Alibaba stock and just expect it to behave just like an American company, but it's actually very different. Obviously, you don't have the voting rights, you don't control any real shares in the companies, and also we have seen some crackdowns here after COVID from the China leadership, and we know that there are some tensions between USA and China in terms of like the tariff situation, etc., that can also affect the situation. So in the end of the day, investors should always weigh these risks before they invest and analyze the stock price. I will just see if I can make it bigger. And analyze the stock price before. So I would say just making that decision in a transparent way that I really understand is quite hard. Because the stock price to me on Chinese stocks, investing this way through the Nasdaq, for example, is quite random, and I don't like that feeling of not being able to long term being certain of which way the stock are supposed to go. If I weigh in like my understanding of the world and potential macroeconomic events, etc. Obviously, you can never know exactly what is going to happen in the world, if it's going to be a war, if it's going to be like earthquakes, whatever. But if you have like a certain development that are kind of the same that it always has been, with ups and downs and contractions and inflation, etc., then you kind of understand where things are going and which stocks long term that are going to perform well. And I just can't really have that certainty when I invest through these kind of structures. I just want you to know that and the real risks here before you enter that type of agreement, because in the end of the day, it's your money and it's your risk. So yeah, that was my take for today, and hopefully this information can help you in some way. Thank you very much.